Hi everybody, it's Jeff. Welcome to Holy Schmidt. This very short episode, we're going to take a pretty complicated tax deduction called the 20% pass-through deduction and simplify it. And we're going to do it all in less than 5 minutes. Coming up in exactly 12 seconds. Hi everybody, welcome back to Holy Schmidt. Over the next few minutes, we're going to go through the 20% pass-through deduction in great detail, but we're also going to make it very simple for you to understand because frankly, for most of you, you won't even need to finish the whole video. The 20% pass-through deduction. Now, first of all, what is a pass-through entity? Basically, it's any business where the taxes are paid by the individual who owns the company, not by the company itself. As an example, Apple, which most of you know, is not a pass-through entity. It is what's called a C corporation. So it pays its own taxes, and then on the dividends that it pays out, the shareholders or the owners of the company pay taxes just on those dividends. But in effect, the shareholders are being taxed twice, once at the company level and then again at the dividend level. A pass-through entity eliminates that and you just get taxed once just on your take-home pay from your business after your business costs. There are 5 different types of pass-through entities. There are sole proprietorships, which is probably most of you, partnerships, which is probably not too many of you, limited liability companies, which could be a big portion of you, limited liability partnerships, probably not too many of you, and S corporations. So for 95% of the people who are watching this video, you're probably a sole proprietor, and if you're not, you're a limited liability company or an S corp. Those are all pass-through entities. Next, over 75% of profitable small businesses will get this tax break because the thresholds are set at reasonably high income levels. If you earn less than $160,700 if you're filing single, or $321,400 if you're the owner of a business that files jointly with your spouse, then you qualify for the 20% pass-through deduction, full stop. And if those are the numbers that you earn or less, you can stop the video here. Don't forget to hit subscribe before you go though, so you can get our next video, but this is all you need to know. But let me give you a specific example for those of you that are so inclined. Joe Fixit is a sole proprietor hardware store owner. He is single and has taxable income before the 20% pass-through deduction of $152,000. He's entitled to take $30,400 off of his taxable income, reducing his overall taxable income to $121,600. Dr. Max Feelgood is a married pediatrician who files jointly with his spouse. His taxable income before the 20% deduction is $318,000. He's entitled to take $63,600 off, that's 20% of $318,000, off of his taxable income, reducing his taxable income to $254,400. Now, the rules get a little bit murky if you are earning more than $160,700 as a single individual or $321,400 if you're filing married and jointly. Because there's a phase out, and the phase out goes at basically it's $210,700, and if you're married, $421,400, unless you have employees and you own property. Then there's a different rule that applies to you. You take the greater of 50% of your W-2 employee wages or 25% of the W-2 employee's total wages plus 2.5% of the original purchase price of the property. Let me give you an example. Bill Fixit, Joe's brother, is a self-employed hardware store owner also. He's single and his taxable income before his 20% deduction is $552,000. So his hardware store does better than his brother's. His staff's W-2s total $750,000, and he does not own any real property associated with his business. Bill can deduct 20% of 50% of $750,000, i.e. 20% of half, or 20% of $375,000. He can take $75,000, which is 20% of $375,000, right off of his taxable income. This means that his new taxable income is $552,000 minus $75,000 equals $477,000. Special service or trade, the rock star phase out. Special service or trade businesses start to phase out the deduction at $160,700 and $321,400. And these are completely eliminated at $210,700 and $421 respectively. There's no option to deduct staff W-2 payments or property used in business as an exception. What are considered special service or trade businesses? Performers like actors, entertainers, etc. Athletes like football players, baseball players, etc. Investment managers like hedge funds. Healthcare professionals such as doctors. Law professionals like lawyers. Accounting professionals like CPAs. Actuaries, consultants, financial services individuals like stockbrokers, and investing professionals. If you fall into a special service or trade category, basically you get nothing after you hit the thresholds. And there's no way to recapture that, even if you have W-2, a high degree of, or high amount of W-2 staff, and or a large amount of business property that you own. So that's basically it. If you like what you just saw, give it a thumbs up so others can find this video as well. Also, if you want to subscribe to Holy Schmidt and get notified when we have other tax publications or business strategy videos that we release from time to time, at least once a week, don't forget to hit subscribe and also ring the bell.